New Zealand attracted global attention last month after unveiling a world-first wellbeing budget. The budget is based on priorities like mental health and child poverty instead of the usual jobs and growth. However, New Zealand Treasury has been engulfed in scandal, and there are questions about whether it's up to the task of implementing this new budget. And it's not the only institution under fire across the ditch. The Reserve Bank of New Zealand is copping flack for its plans to double the amount of cash that banks have to hold as a buffer against bad times. The non-partisan think tank, the New Zealand Initiative, has been critical of both Treasury and the central bank. The group's Oliver Hartwich joined me. Oliver Hartwich, the government announced this wellbeing budget lauded around the world, but you have concerns about whether it can be implemented.
Yes, indeed, and we've got some questions about that. Not just because we've had a scandal in New Zealand over the last week relating to a leak from the budget, which actually turned out not to be so much a leak, but a carelessness on part of Treasury, putting the stuff on the Treasury website early so the opposition could just Google it. But actually the competence of Treasury to really properly do cost-benefit analysis, because Treasury has actually leaked a lot of economic expertise over the last few years. They've lost many of their senior, really well-qualified economists, and they weren't able to replace them. So if we're now asking Treasury to help us implement a well-being budget, measure it, do some really sophisticated economic modeling, we are concerned that Treasury simply won't have the people in-house anymore to do that.
Do you think it's actually threatening the economy?
Well, it will definitely have an effect on the way that the New Zealand government spends and evaluates its policies. And then, of course, long term, there will be an effect on the economy because we need Treasury. Treasury has a role in New Zealand as the lead economic advisor for every government department. So every government department that wants to do stuff has to get this stuff actually past Treasury at some stage. And then it's Treasury's role to really go through it and figure out whether it makes any sense, whether it's good value, whether it's value for money, whether it works. And for that, you need expertise and competence. And unfortunately, Treasury is in no position currently to do that job properly.
Another major issue confronting New Zealand is the Reserve Bank's drive to lift the safety buffers for the big banks. Your organisation and the banks are very much against this. Why? Why shouldn't banks be made as strong as possible?
Well, the RBNZ and the RBNZ governor, they are totally right to be concerned about the next financial crisis and how our banking system would fare under such a crisis. However, they also have to take into account, of course, that an insurance policy against the next financial crisis and against potential bank failures in New Zealand is not costless. In fact, it's quite costly. What they have proposed now is to protect New Zealand banks to such a degree that we would probably see maybe one bank failure in 200 years. But in order to get there, what they do is they will require the banks to hold much more capital. And we're talking about probably between 15 and 20 billion New Zealand dollars of capital that the banks would have to hold. Now, the banks, of course, would then see their profitability reduced, probably to the tune of about $1.8 billion a year. And then you have to, again, do a cost-benefit analysis to ask yourself, is that an insurance policy really worth paying? Because on a rough, back-of-the-envelope modeling, we would estimate that maybe you get benefits on average of, say, $50–60 million a year, but you're paying a $1.8 billion insurance premium on that.
It's been discussed here in Australia that should the Reserve Bank of New Zealand go through with lifting the buffers, Australian banks, which are most of your major banks, will leave New Zealand. Is this considered a serious threat?
Rather than pulling out of the market, the banks will try to recover their losses somewhere else. They will probably put up mortgage rates. They will probably restrict their lending. And it's interesting, just today we heard from federated farmers in New Zealand that they are opposing these new capital requirements because they are concerned about capital availability for lending to the agricultural sector in New Zealand, which would materially slow down the New Zealand economy. So I think rather than pulling out of the New Zealand market, which for the banks is actually quite a profitable market, we would see some lending restrictions, we would probably see higher mortgage rates, and all of this would have an impact on New Zealand economic growth.
So it sounds like you believe there needs to be a major shake-up of both New Zealand's Treasury and Reserve Bank.
Yes, I think some of these concerns are justified, and they really come down to the same denominator. What we need stringently in New Zealand across all regulators is better cost-benefit analysis, more economic analysis of proposals being made. It's not good enough to just have good intentions. You actually have to check out whether these policies you want to implement will really work. So I think on that front we have some problems in New Zealand. We also have another problem that we haven't even mentioned. We think we need a different structure for our main regulators in the economy. The problem that we see with the Reserve Bank, for example, is that currently decision making is concentrated in one person, that's the governor. We think regulators typically perform a lot better if there is a proper board checking on the performance of the governor.
Oliver Hartwich, great to have you on.
Thank you.